Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Considering the U.S. bombing of Iran's nuclear facilities over the past weekend, U.S. stocks are only modestly softer. No major panic yet. Bloomberg notes the market is treating the strikes as a non event, for now. Reuters reports global equity markets have edged lower, oil briefly spiked, and investors are awaiting Iran's response. The consensus view leans toward a contained military action with limited expectations of broader conflict, at least for the moment. Brent crude jumped 1.2% today to 78.79 barrel on fears of supply disruptions via the Strait of Hormuz. Analysts warn that a prolonged shutdown could drive prices toward $130 per barrel, pushing U.S. inflation toward 6% and eliminating hopes for rate cuts this year. The U.S. dollar is strengthening amid risk-off sentiment. Treasury demand is moderately elevated, though bond yields remain roughly flat. Iran's response could include missile or drone strikes or targeting oil infrastructure, which would threaten supply lines and hit sentiment. Any disruption to the Strait of Hormuz would reverberate sharply through commodity and equity markets. Extended involvement by the U.S. could trigger safe haven shifts to the dollar and treasuries, but potentially dent long-term growth and equity valuations. Last week, the OECD lowered its global growth outlook for 2025 and 2026, citing mounting trade barriers, heightened U.S. policy uncertainty, and tighter financial conditions. The organization now projects global GDP to slow from 3.3% in 2024 to 2.9% in both 2025 and 2026, down from its March 2025 forecast of 3.1% and 3.0% respectively. The U.S. forecast was cut to 1.6% for 2025 versus 2.2% in March, and to 1.5% for 2026 versus 1.6%. Implication: global economic growth is forecast to slow more than anticipated only a few months ago as the Trump administration's tariffs impact the U.S. economy. Last week's soft and hard data releases indicate the U.S. economy is cooling. Retail sales missed expectations with a 0.9% decline, the second consecutive monthly decline. Industrial production contracted, falling for the third time in 5 months, with year-over-year growth at a 6-month low. In housing, home builder sentiment fell to the lowest level since December 2022, while both building permits and housing starts point to continued weakness ahead. Meanwhile, the City Economic Surprise Index shows that most data have come in below expectations since mid-February. Implication: consumer spending is slowing, manufacturing activity remains sluggish, and housing activity continues to decelerate. The Fed held its June FOMC meeting last week. As widely expected, the central bank held interest rates steady for a fourth consecutive meeting and reiterated its patient, data-dependent messaging. In his press conference, Chair Powell described the economy as solid, supported by low unemployment and steady growth. However, he cautioned that inflation remains above target with upside risk from tariffs and geopolitical tensions. Implication: the macroeconomic backdrop is highly uncertain, and the Fed is waiting for clearer signals before acting. Both the Fed and the market appear overly complacent. While there are clear signs of economic softening, the focus is on inflation rather than slowing growth. The next few months will be critical in shaping the outlook. Implication: the market and economy are at a crucial juncture, and Q3 economic activity will provide valuable context about the path forward. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website,